Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Sharon Lacey. Sharon is a wealth manager at United Capital Financial Advisors in Los Altos, California. She began her career as a computer engineer working for Hewlett-Packard, and in 2005 she decided to pursue her interest in financial planning. She became a certified financial planner, and so we call that CFP initials these days. So she became that in 2009, and then she became a certified private wealth advisor professional, CPWA, in 2014. She's a member of the Financial Planning Association and the National Academy of Social Insurance, and has spoken regionally and nationally about Social Security planning. I actually attended one of Sharon's presentations, and I was so impressed I asked her to come and be a guest. So today, Sharon and I are going to be talking about some basics related to Social Security, and then we're going to do another interview, and we're going to cover some issues for married couples. Sharon, thanks for joining me today.
You're so welcome. Thanks for having me.
Okay. So how did you decide to get into this area, become an expert on Social Security?
Well, in about 2008, I started recognizing that my clients needed to have something in terms of strategies with regard to when to claim their Social Security benefits. And it's a very complex process. And I used to sit down with a sheet of paper and try and figure it out. And after a while, it got so complex that I really came to the conclusion that I needed to write a tool. So I learned everything I could about Social Security, and I actually initially implemented an Excel spreadsheet to optimize Social Security planning strategies. And along the way, I just learned everything I could about Social Security.
Okay. So you mentioned somewhere along the way that these rules, I think most of us know, anyway, anytime you're dealing with something that's a government program, the rules are complex. So maybe you can address that a little bit, talk a little bit about that complexity.
Yeah, the reality is that when you go on the Social Security website, they give you very basic examples of if you file at 62, or if you file at full retirement age, or if you delay until 70. And usually their examples are very simple. The husband and the wife are the same age, and they have relatively similar benefits. And so it's very difficult to really suss out the more complex scenarios. And so if one couple, if there's a significant difference in age, like 10 years, for example, or if there's a significant difference in their benefits, there can be a lot of complexity. And for example, I have a client who's actually 13 years younger than her husband, and she has the higher Social Security benefit. But it actually makes sense for her to file at 62 and for him to delay his benefits.
Isn't that something?
Yeah, rather than what would seem to be the obvious, which is that generally speaking, we recommend that the higher benefit spouse is the one to delay. And in that particular instance, because of the complexity of their particular situation, it doesn't work out to be the optimal scenario.
Isn't that something? Okay. Let's talk a little bit about the system in general. Many people are worried that Social Security benefits are going to be reduced or eliminated in the future. So what do you have to say about that?
Well, the first thing I have to say about that is that the members of Congress pay into and will receive Social Security benefits, and I don't think that they're going to let them go away. However, there is a crisis that needs to be dealt with sometime in the near future, and that is that in about 2022, the Social Security Administration is going to have to start tapping what's called the Social Security Trust Fund, which is really a lot of Treasury notes that are kept for the Social Security Administration. And they've been basically supplementing. There's been a shortfall for a few years in terms of the money that's coming in from the Social Security payroll tax and the benefits that are paid out. And the Social Security Administration has been making up that difference with interest received from those trust fund assets, they are actually going to have to start tapping the principal of the trust fund in the near future, and that is anticipated to completely be exhausted by about 2033. And at that point in time, the Social Security Administration would only be able to pay about 77% of the benefits. But there are a lot of proposals for how to fix the system, and I am very confident that Congress, members of Congress, are not going to allow their benefits to be reduced.
The people who vote are seniors. And they want their Social Security.
Absolutely.
And the AARP is leading the charge. So anyway, so yes, there will be something that's going to happen.
Yes.
Okay. Are Social Security benefits taxable?
Absolutely. I believe that they were initially, that actually Ronald Reagan was the person who actually started the taxation of Social Security benefits, and a lot of people object to that, which I can understand, but it actually provides a significant amount of income. And as a matter of fact, one of the proposals for fixing Social Security is actually to increase the amount of Social Security benefits that are taxed. But right now, if you make, if you're married filing jointly and you make less than about $32,000, none of your Social Security benefit is taxed. Mm-hmm. If you make somewhere between $32,000 and $44,000, that's it's what's called the Provisional Income, which includes your income plus part of your Social Security benefit. If you make more, if that's more than $44,000, or if it's between 32 and 44, then 50%, up to 50% of your Social Security benefit will be taxed. And if you make more than $44,000, then up to 85% of your Social Security benefit would be taxed.
Yeah. So it's actually quite complicated, and as I recall, doesn't tax exempt income also play into this?
Yes. When I talk about provisional income, the formula is actually you take your AGI that you just get off of your tax form, mm-hmm. and you add back in your tax-free income, and then you add in half of your Social Security benefit, and that is the number that you work for when you see where you fit.
Mm-hmm. Okay. How can you get a record of your Social Security account and expected benefits?
Well, the easiest way to do it, there's actually a couple of ways to do it. If you're just interested in getting an estimate of your benefit, you can go to www.ssa.gov, and there's a link there to the estimator. And you can then go on the estimator, and they ask you a few questions. They ask you your Social Security number and what city you were born in. They ask you a few questions, and then they'll give you an estimate of what your Social Security benefit is. But I would actually recommend that people log in to Social Security. You can create an account at My Social Security, and or go to ssa.gov, and there's a link that will take you to My Social Security, and you have to create a login. And then you can actually look at your full statement. And Social Security used to mail those out.
I think they still do, because I have one in my files.
Exactly, they do, but they don't do it every year, unless you, I believe that once you reach 62, they start mailing them out more frequently. But if you need to get a copy, on the spur of the moment, you can actually go online and log in and get a full statement. And that's really important because your Social Security benefit is based on your earnings history. And if you recall from when you used to get Social Security statements, the third page tells you what your earnings history is. And you need to verify that that earnings history is correct, because Social Security will only allow you to go back for 3 years to correct any errors. And so if you're missing years, for some reason they didn't get a W-2 from your employer, or something happened and they missed that year, then your Social Security benefit will be reduced because of that missing information.
Right. So even people who aren't sitting on top of retirement, they should be looking at these accounts from time to time.
Absolutely.
To make sure that they're getting all the credits that they're entitled to. Okay. What is the full retirement age, and why is that significant?
Full retirement age is significant for a lot of reasons, but probably the most important reason is that if you want to receive 100% of your Social Security benefit, you have to wait to file until your full retirement age. And for me, who was born in 1952, my full retirement age is 66. For someone that was born in 1960 or later, their full retirement age is 67. And it matters because if they take their Social Security benefit early, for example, at 62, someone whose full retirement age is 67 will have a greater reduction in the benefit for taking it early than I would if I filed at 62. Because for me, I would only be filing 4 years before my full retirement age if I took my benefit at 62. For someone whose full retirement age is 67, they would be retiring 5 years before their full retirement age, and that impacts the benefit that they get.
Okay. So how do you file for early benefits, and what's the significance for that election?
Well, you can, anytime after 62, you can retire, you can file for your own benefit. And for me, whose full retirement age is 66, I would take a reduction in my benefit, and so I would receive 75% of my full retirement age benefit. Mm-hmm. If I retired at 63, I would get 80% of my full retirement age benefit, and it's every month, actually, that you get closer to your full retirement age, your benefit will increase until when you reach age 66, you'll get 100% mm-hmm. of your full retirement age if your full retirement age is 66. But keep in mind that filing early does not just impact you, because if you're married and you predecease your spouse will have the choice of either their own benefit or your benefit. And if you took your benefit early, you're essentially penalizing your spouse going forward because they're going to have less in the way of benefits in the long run.
Okay. So what's the significance of waiting until age 70 to claim benefits?
Well, we encourage the higher earner. Of course, as I said in my example, it depends on your particular situation, but we encourage the higher earner or the higher benefit spouse to delay until 70. And the benefit is, this was something that was not originally part of the Social Security system, but Congress decided that they wanted to try and encourage people to continue working. And so in about 2000, they implemented a program whereby you can actually delay your benefit, and for every year that you delay your benefit, you get an 8% increase in your benefit. So for me, whose full retirement age is 66, if I delay the 4 years from 66 to 70, I'll actually get a 32% increase in my benefit. And the difference between filing at 62 and filing at 70 is actually a 76% increase in benefit. And so it really is important. We like to think of delaying Social Security as longevity insurance. And if you live a long, long time, you're going to be very thankful that you delayed your benefit until 70, because that's going to augment your retirement income in a very meaningful way.
Mm-hmm. So I would think that one of your questions would be, how's your health?
Absolutely. Most of us don't have any idea how long we're going to live, but some new longevity numbers actually have come out recently, and for people who are in the top income demographic, life expectancy has been increasing significantly, and so it is now, if you're 65, you have if you're a man, you have a 50% chance of living until you're 86. Mm-hmm. If you're a 65-year-old woman, you have a 50% chance of living until you're 89. Mm-hmm. So longevity is, people should really take it seriously, that they could live a very long time. And of course, if you know for some reason that you are not going to live to your life expectancy, if you have a good reason to believe that that's not going to be the case, then you need to do special planning to make sure that if you're married, that your spouse still receives the highest benefit possible based on your planning.
So you're not, again, just thinking of yourself, because I heard somewhere, and it might be just on the IRS table, I think it is. So the joint life expectancy for a couple at age 65, I think, is about 35 years.
Yes. Also, these new numbers that have recently come out,
Yeah, they're probably gonna try
that
that.
there's a 25% chance that one member of a couple, being married has all kinds of advantages. One of the advantages is longevity. There's new statistics that show that at least one member of a couple has a 25% chance of living beyond 95.
Yeah. Well, because I said age 65, life expectancy 35, that's 100.
Yep.
And anyway, so we expect a lot more people to be living beyond 100 than did in the past.
Yep, absolutely.
And so that's a long time to make your money last.
It sure is.
Yeah.
That's why we talk about it as longevity insurance.
Yeah, okay. So what about the earnings test threshold? Let's talk about that a little bit, because a lot of people, I think there's some confusion about it, for one thing.
There absolutely is.
And do you lose benefits when you exceed the threshold? How does that work? And then when you reach full retirement age, does that continue to apply? Why don't you explain that a little bit?
Yeah. So if you earn more than $15,700, that's the number for 2016. That number gets increased for inflation every year. But if you make more than $15,720, I believe it is, the Social Security Administration will withhold $1 for every $2 you make. But that's only until full retirement age. After full retirement age, the earnings test goes away. But you don't lose that money. What happens is that, for example, if you make enough money that, let's say, 50% of your Social Security benefit gets withheld, and you continue working all the way until you're 66. So let's say you file at 62, and between 62 and 66, 50% of your benefit gets withheld. When you reach 66, the earnings test goes away. But in addition, in spite of the fact that you filed at 62, Social Security will change your filing date to 64 because you've only received 50% of your benefits. So they're assuming that it's as if you, instead of having filed 4 years before your full retirement age benefit, that you only filed 2 years before your full retirement age benefit. The calculation is actually a little bit more complex than that, but that's essentially what happens. And so the money doesn't go away, it simply gets withheld.
I see. So
and in the year you turn full retirement age, that changes. The threshold changes to over $41,000 you can make before you're subject to the earnings test. And for every month in the year that you turn full retirement age, for every month that you are working, they will withhold $1 for every $3 that you make.
Wow. So when does it actually cut off then, where you're no longer subject to the test at all?
Full retirement age.
Full retirement age.
Yep.
Then. Okay. What happens if you have retirement income from a government job?
Well, if you are going to receive a pension for which you did not pay into Social Security, so in California, a lot of people who receive CalSTRS pensions are in that situation.
There's a CalPERS deal, yeah.
Yeah, and actually it turns out that CalPERS did a switch over, and so that a lot of people who have CalPERS pension at some point in time did start paying into Social Security. And so they are not necessarily subject to the same restrictions.
Okay.
But certainly CalSTRS, people who receive a CalSTRS pension probably did not pay into Social Security. And if that is the case, then they are going to be impacted when they actually do file for Social Security because their benefits are going to be either reduced or in some cases eliminated.
Okay. So this is something really that you need to consult with somebody about for the details for how it impacts you.
Yes, just briefly, if you are the one receiving, for example, let's use the example of someone who worked as a teacher, earned a CalSTRS pension, but then also perhaps worked in a private school and paid into Social Security. If they have less than 20 years of Social Security earnings, what's called Social Security substantial earnings, which is about $1,200, $1,300. I mean, if they have less than 20 years of substantial earnings, then they can expect to have their benefit reduced by about $400 a month. That's actually the maximum that it would be reduced. So their Social Security benefit will be perhaps significantly, perhaps only slightly reduced, depending on what their benefit is. However, if they are receiving a CalSTRS pension and they're anticipating the possibility of having either a spousal or survivor's benefit, that benefit could actually get wiped out completely by the fact that they have a CalSTRS pension. Because the calculation is that Social Security will say, we're going to take two-thirds of your pension, and we're going to figure out what that is. So if you have a $3,000 pension, they're going to say, okay, the number is $2,000, and we're going to subtract that from any spousal or survivor's benefit that you might get. And so in most cases, it wipes out, a pension like that would wipe out a spousal benefit and would significantly reduce, if not eliminate, a survivor's benefit as well.
Okay.
And that's called the government pension offset.
Okay. Now, there's one other thing that I didn't really ask you before, and that's just how is your Social Security benefit computed?
Well, it's actually very interesting because it definitely is based on your earnings history. And so, as I said, on page 3 of your statement, you can look at your earnings history, and hopefully you have 35 years of earnings. So I started working actually in 1973. But I actually worked at Lawrence Livermore Labs for 4 years, and so paid into a CalPERS pension. So I didn't pay into Social Security at that particular point in time. And so I have 4 zeros in my earnings history. So the way it's done is the first step is to calculate what's called the average index monthly earnings. So they take all of your earnings, and the first thing they do is they try and make every year of your earnings essentially equivalent to 2016 earnings. So they index it. And then they take the highest 35 years and they average those. And so if you have zeros in your earnings history because either you didn't work 35 years or because you took some time off or because you were paying into a CalSTRS pension, then you would have zeros for those years, and that would reduce your average. So the first step is average index monthly earnings, and then the next step is calculating the primary insurance amount, and that is the one way in which Social Security is progressive. So you get credit toward your PIA, which is really basically your full retirement age benefit. You get credit for your PIA at different levels. So for about the first $800, you get 90% of whatever your average index monthly earnings is. And then for the next section, which is about $242 or $4,300, actually this year it's up to $5,200, I believe, you get credit for 32% of that tranche. And then anything above that, you get credit for 15%. So someone who is a very high income earner who delays until 70 might only be seeing about 44% of their benefit, whereas if you're a low benefit individual, you might be seeing 75 or 80% of your average index monthly earnings in your Social Security benefit.
So, and then there's a ceiling, I guess, and it's based on the maximum amount that's subject to Social Security, is that right?
Yes, Social Security it's called a cap. And as a matter of fact, one of the ways that I would like to see the Social Security problem eliminated is to what's called scrap the cap. And so the cap is currently at $118,500, which means that you can earn up to $118,500 and you'll get your 6.2% Social Security tax will be assessed against that. And then everything above that is not taxed at all. It is taxed for Medicare, but it is not taxed for Social Security.
Yeah. Okay, well, we only have maybe about a minute left, so maybe there's a final thought or two that you'd like to throw out.
Well, I just really want to make sure that people remember that Social Security is longevity insurance. And so if there's any way that you can figure out a way to delay claiming your Social Security, it's going to make a huge difference in terms of your retirement income. I also want to, I believe that we'll be talking in the next section a little bit about the restricted application. I really want people to understand how that is. And that one of the things that didn't get taken away with the law change that happened in October is the ability to coordinate survivors' benefits. And I believe we'll be talking about that as well.
Yeah, we'll get into that into more detail. Right. I think there was one other thing that you wanted to say, the last point that we had here, and that's that if you think that you're entitled to a benefit, someone at Social Security says something different, don't take that answer.
Yeah, I have talked to a lot of people who've gotten turned away by Social Security with some of the strategies that they can legitimately do. The people at Social Security are very nice and very helpful, and I've had clients where a Social Security employee has called them back to help them make a better decision about their filing strategy. So I have nothing but good things to say about Social Security. I am a little concerned sometimes about the training of the people who are on the front line, because I have had several clients go into a Social Security office and ask to do something that's completely legitimate and be turned away. And so my advice is that if you go into Social Security and ask to do something and they tell you you can't do it, to ask to speak to a supervisor. And if even they say that you can't do what you're trying to do, then you need to try and find somebody who is really comfortable and familiar with the Social Security rules, so that you can find out whether or not, in fact, the people at Social Security are correct, or whether or not they simply don't understand the very rules that they're trying to implement.
Okay. And I think there was one other thing that you said, that if you go in to talk to Social Security people in your retirement age, and you're trying to get to that age 70 threshold, you have to be very careful as well.
Yes, I've had clients go into Social Security and say that they were planning to file at 70, and maybe they were 68. And the Social Security person said, well, as long as you're here, why don't you go ahead and file for your benefit?
Okay, we have to finish now. So there's a guide that's available, the Social Security Claiming Guide. How do they get that?
This is from the Center for Retirement Research at Boston College, and you can go online and you can actually get a printable PDF version of this file, or you can contact them and ask them for copies.
Okay. We're out of time. There's a website where you can find the optimizer that she talked about at the end of the show. See you next time on Financial Insider Weekly.